Every single company has a story. It's a tale of big bets, fierce competition, and, hopefully, brilliant execution. But that story, it isn't just written in press releases. It's written in the numbers, hidden right there in plain sight on their financial statements. And today, we're going to learn how to read it.
Okay, let's jump right in with a real-world mystery. The year is 2009. We've got two titans of the PC industry, Apple and Dell. Now, on the surface, they're in the same business. But if you peek at their financial reports from that time, you'll see they were on completely different planets.
So, check this out. In 2007, Dell was the undisputed king, with sales more than double Apple's. But fast forward just 2 years, and whoa, the script has totally flipped. Apple sales just exploded, up over 70%, and their operating income, basically their core profit, shot up an unbelievable 165%. Meanwhile, Dell, the big leader, was actually going backward. Sales were down, and profits got slashed by a third. It's a super dramatic story, all told in just 4 lines of data.
So we know what happened. The numbers don't lie. But they don't tell us the whole story, do they? Why was Apple's strategy, betting the farm on high-end stuff like the iPhone, working so well, while Dell's super efficient, low-cost model was starting to run out of gas? To answer that question, we have to dig deeper. We need the tools of financial analysis.
Think of financial analysis like a detective's kit. Seriously, it's packed with all these cool tools that help us look past the big, flashy numbers and find the clues that are hiding inside the data. So let's open up the kit and look at the 2 most fundamental tools we've got. First up is ratio analysis. This is basically our magnifying glass. By taking one number and relating it to another, like say profit compared to sales, we can create a standard metric. And what this does is it gets rid of the whole size issue. It lets us make, apples to apples comparisons, no pun intended, so we can see how a company is doing over time or how it stacks up against its rivals. And our second tool is something called common size analysis. This is kind of like creating a blueprint or an X-ray of the company. We take a whole financial statement and we turn every single line into a percentage of one big item, like total revenue. All of a sudden, we're not looking at raw dollars anymore. We're actually seeing the company's financial DNA, how it's built, its basic structure. But here's maybe the most important rule for any detective. The clues are not the answer. This quote says it perfectly. A ratio tells you where to look. It's like a big flashing arrow pointing to a strength or a weakness. It tells you what happened. But it's our job, as the analysts, to figure out why. All right, let's put our detective kit to work. Now, before we totally solve that Apple and Dell mystery, let's do a little warm-up. We'll look at another group of PC competitors from around the same time, Acer, Lenovo, and Toshiba. This is going to help us get a feel for how to pull the story out of the numbers. Okay, so right off the bat, we have a problem. Comparing their revenues is kind of impossible. They're all reporting in different currencies. But as soon as we apply a simple ratio, the currency exchange rate, and convert everything to US dollars, a clear picture emerges. And you can see, Toshiba was an absolute giant, just dwarfing both Acer and Lenovo. But as we know, size isn't everything. When we switch our focus from a single year's revenue to their growth over a 4-year period, the story completely flips. Look at this. Acer, the smallest one, is growing at a blistering pace, almost 16% a year. And meanwhile, the giant, Toshiba, is practically standing still. This is our first major clue about what's really going on with their strategies. So Acer is growing fast. We got that. But is it profitable growth? Are they just burning cash to get bigger? Well, we can investigate that with the net profit margin ratio. This tells us how much profit they make for every single dollar of sales. And would you look at that? Even though Acer was known for its low prices, it was actually the most consistently profitable of the 3. It's growing fast and holding on to its profits. That is a really powerful combo. But here's the thing. Performance is just one part of the story. A company can be growing like crazy and still be really unhealthy financially. It's kind of like a world-class sprinter who has dangerously high blood pressure. So now we need to use our tools to check the company's financial vital signs. The first vital sign is liquidity. In simple terms, this just means, does the company have enough cash or stuff it can turn into cash quickly to pay all its bills that are due soon? It's really about day-to-day survival. One of the best ways to measure liquidity is with something called the cash conversion cycle. It sounds complicated, but it's not. It just measures 3 things: how many days it takes you to sell your stuff,
how many days it takes you to get paid by your customers, and then it subtracts how many days you take to pay your suppliers. So let's apply this to Dell, remember them from our mystery, and you can really see the magic of their business model. The absolutely incredible thing here is that the number is negative. A negative cash conversion cycle is like the holy grail of business efficiency. Just think about what this actually means. Dell was collecting cash from its customers a full 36 days before it even had to pay its suppliers for the parts. Their business wasn't just selling computers, it was a cash-generating machine.
Okay, the second vital sign is solvency. And if liquidity is about surviving the short term, solvency is all about the long haul. Can the company meet its big, long-term debts, like bonds? This is where we look at a company's debt, or what analysts like to call financial leverage.
We've looked at performance. We've checked the financial health. Now it's time to bring it all together with our most powerful tool yet, a framework that connects all the clues we've gathered. This is called the DuPont analysis.
For a company's owners, the shareholders, the most important metric is return on equity, or ROE for short. It tells you how much profit the company's making for every single dollar the owners have invested. But a single ROE number doesn't tell us the whole story. DuPont analysis lets us crack it open and see what's really driving it. So the magic of DuPont is that it shows us that ROE is really driven by three distinct levers a company can pull. First, there's profitability, how much profit you squeeze out of your sales. Second is efficiency, how well you use all your stuff, your assets, to generate those sales. And third is leverage, how much debt you're using to pay for all that stuff.
Let's see this in action with a company called Anson Industries. Their ROE went from negative to almost 6%, a huge improvement. But why? Well, the DuPont model tells us exactly why. Look, their financial leverage, how much debt they used, stayed exactly the same. The entire improvement came from getting way more profitable and much more efficient. This is the kind of analysis that would show us exactly how Apple was pulling away from Dell, by boosting those profit margins, not just by taking on more debt.
In this, right here, is the real power of our detective kit. By using a framework like DuPont to break down a single number like ROE, we can diagnose the health and performance of the whole company. We can actually see the story of their strategy. Are they winning with high prices, or are they super efficient, or are they just taking on more risk? The model tells all.
And that brings us right to our final thought. The next time you see a company with a fantastic return on equity, you'll know to ask the right question. Are they just an amazing, efficient, profitable business? Or did they just pull that leverage lever hard, taking on more debt and a ton more risk? Thanks to your new detective kit, you'll know exactly how to find the real answer.